everyone, and welcome. This is the Daily Finance Wrap, and I'm your host, Avan Dabash. This is the show that gets you all the latest updates when it comes to personal finance, investments, insurance, real estate, and of course, expert analysis. And we want it to be interactive. So if you've got any questions and queries toward the end of the show, we promise to get that answered with our experts. All right, today on the show, we've got lots lined up for you. And as you know, it is Dussehra tomorrow. This, of course, represents the good over evil. And what if we were to actually apply that principle in our lives and in our investments as well? Are there evils when it comes to our investing habits? And is that preventing us from actually creating and preserving our very own wealth? Well, we'll be decoding that with our guest later on the show. But let's begin, as always, with the top trending topics in the world of finance. Well, first up, the government is coming down hard and planning a crackdown. This is on e-commerce companies because they've been getting several complaints from consumers talking about online retailers who are actually going ahead and flouting norms related to dark patterns with the ongoing festive sales. Now, what exactly are these dark patterns? Dark patterns are basically deceptive techniques that are used by these online platforms with the aim of luring users because they sneak something extra into your cart at the last minute during the checkout, and that sort of creates a false sense of urgency. They say things like only one item left. And this festive season, do remember, it's important for you to be vigilant. It's important for you to be spending prudently and keep a watch on this. And next up, what is dominating big headlines is the fact that Noel Tata has been appointed as the chairman of the Tata Group's philanthropic arm, that is Tata Trust, as per multiple news reports. Do remember, he is succeeding his half-brother Ratan Tata, who passed away just yesterday. Now, reports say that this has been a unanimous decision that has been taken by the boards in the meeting that was held in Mumbai. Ratan Tata, remember, has not married, he has no children of his own, and he has not even named a successor for Tata Trust. And therefore, Noel Tata's appointment assumes significance given the fact that the Tata Trust owns 66% of Tata Sons, which is the holding company of the various companies under the Tata brand, which is over 150 years old. And in other top stories, the rupee has actually breached the mark of 84 to the US dollar for the first time ever. There's a number of factors that can be attributed to this, one being the fact that you have seen crude oil prices that have rallied. In this week alone, it's been a rally of nearly 10% in crude oil prices. But not just that, you've also got foreign institutional investors or FIIs that have been hitting the sell button hard. And there have been a massive outflow of funds from the foreign institutional investors, and they have been net sellers continually. All right, those were some of the top stories, but as promised, we have our theme today. We want to discuss the representation of the Dussehra, the triumph of good over evil. We want to help you triumph some of the very common mistakes that people make, some behavioral habits that just need to be nicked away, so that can help you to create wealth, to preserve your wealth, and more importantly, to compound your wealth. Well, joining in for this discussion, we have with us Srikanth Bhagavat. He's a managing director and principal advisor at Hexagon Capital Advisors. Thank you so much for taking time out and joining us today. Great to have you. Let's begin by just talking about some very typical bad habits. What are some of the common money mistakes you think people really make that really holds them back from expanding, creating, and compounding their wealth?
Hi. Good evening, and thank you for having me on the show, Avan. Okay. So, since you made this comparison with Dussehra and everybody has in mind Ravana and his 10 heads, I would think that, 10 evils are just not enough. I think we all have more Ravanas behind us, obstructing us in the way we manage our wealth. So let me talk about a few of these things. Some of these are related to managing personal money, and some of them are related to actually how we manage our portfolios. Okay, so let me talk about how the common mistakes people make when looking at their personal finances. I think from the 25 years that I've been working with people and families, when they come to us, they are rather immature in their personal finance habits. And the one error I see happening in their lives is that they do not spend time on tracking their expenses. Okay, so they come with a good intent. They want to save, but they can save only after they can figure out where they're spending, how they're spending, and how much they're saving. So the first step I think one should take on the way to preserving wealth and growing wealth is going through a budgeting exercise, tracking your expenses, figuring out where you're spending more, where you're spending less, and you'd be pretty surprised at the kind of results it throws up. You know, there was this case where there was just no money being left at the end of the month to save, and the investor was thinking that she was very prudent in her spending habits. But when we made her actually go through the process of tracking expenses, she discovered that a lot of money was going out in eating outside. Okay, it was not transport, it was not kitchen, it was not groceries, it was eating outside that was taking away a lot of expenses. And once you're able to pinpoint the problem, okay, then you can hold back. You have some element of control over it. Okay, so tracking expenses, budgeting has to be done. Another one I would think about is spending more than our ability, or we would call it overspending. Okay, and overspending is probably a disease many of us have gone through, and it's just because we are not able to hold back our temptations. And the moment you see something, you give into the temptation, you buy, and at the end of the month, you really have nothing left to save. Okay, and what's worse is that you may end up borrowing to spend. Okay, everybody has a credit card, and you swipe your credit card, and without knowing it, day on day you're spending more than what you have in your bank account. Okay, and you run up a huge bill, and you start paying massive interest rates at the rate of 3% per month, and suddenly you find that you're not even able to pay the interest. So these are the kind of ruts one can get into if you're overspending, and in this digital age, you have a nice credit card in your wallet and you keep swiping it. Okay. So these are some of the issues that can come up. The one myth that I would like to bust here, Avan, is that one should not think of savings as what is left over after spending from your monthly income. No, that's a very passive route to take. If you want to take charge of your future, if you want to take charge of growing your wealth, then you need to look at it exactly the inverse. Okay. You spend only after you save. You have your income, you save first, what is left over is what you spend. Income minus savings is equal to expenses. Can we get this equation into play? Then you really have it going.
Yeah, you really, of course, you have highlighted, so many issues and niggling worries that credit card can really be a deterrent for many. But I would assume as well, that there are a lot of these sort of biases that people have, investor biases that are very common. We won't let go of a non-performing stock for some reason or the other, or maybe perhaps we're too pessimistic. Can you highlight some of those biases that are very common in investors?
Oh, yes, surely. I mean, see, biases are something we really don't realize. They creep up on you from the back because they're all subconscious. They're part of our DNA, they're part of our evolution. And if you ask somebody on their face, do you have biases? They say, no, I don't have any biases. I'm very fair. I'm very clear on what I want to do, and I know what is right, what is wrong, etc. But what is it the subconscious pops up? Some of the ones that pop up, as you were saying, Aman, is that when you're looking at a portfolio and you have to sell something to buy another stock, another bond, or you have to sell something to fund some expenditure, there are many people who first look at selling off the good stocks and keeping the losers. This is called the disposition effect. Okay? And this bias, if not controlled, can make you end up with holding a whole bag of losers in your portfolio rather than a whole bag of winners. Okay? It's this bias where you think that, hey, I know this stock is low. I know it is not doing well now. It is in a loss, but probably if I hold on to it, it'll do better in the tomorrow. It'll do better in the future. And one should realize that the market pays for good businesses, and you end up selling your good ones and only have bad ones and lose out on all the compounding, lose out on your capital. Okay. So this is something that you should learn. You should actually learn to let go of the losers first and keep back the good ones. Just imagine you're gardening and you're pulling out all the flowers and leaving only the weeds behind. The flowering plants are the good ones and the weeds are the losers. And soon your garden will only be full of weeds. You don't want that, do you, for your portfolio? Another bias that we are subject to is called the overconfidence bias. Okay. And this is a bias where we think that we know everything. We think we are the experts and we have no need to take anybody's advice for whatever action we are doing. Somehow, over time it has come to be that as far as investing in stocks is concerned, each one considers themselves an expert. Okay. Rather funny, but then it's not the case. So overconfidence makes you take decisions which you're not geared to do. You take decisions which you're not wired to do. Okay. So you end up taking more risks. You may have a skewed asset allocation. You may have more in equity. You may have more in small and mid cap. You may have more in micro cap, or you may have lent more in bad credit or low grade credit. All these are biases which impact the portfolio coming out of overconfidence. Okay. And once you realize that you have an overconfidence bias, then you should go deeper, study data, study facts, and then only take decisions. Okay. And also a great way to do is maybe go sit with a planner and figure out what is your risk profile. Another one that we have going commonly that I find whenever I come and meet my clients is this thing called representativeness. Okay. And what the word sounds big, but what it actually means is that you're extrapolating small data sets to forever, to kingdom come. Okay. So just because you see, say, a defense sector doing well in the last 2 months, and you think that defense sector will do well forever, and you pile into the defense sector. Okay. So a small set of data that is, say, a quarter or a year of doing well, and you think it will do well forever. So something like this could end up making you take wrong decisions. Okay. Another example of representatives is just because the market is doing well now, you think it'll do well forever. But we know as experts that markets go through ups and downs. They're cyclical in nature. Okay. And you really cannot extrapolate anything in the short term or medium term. The representatives bias can cause this extrapolation in your mind, and you end up taking up wrong investment decisions. Anchoring is another commonly found bias, Avan. Okay. And this is where one is influenced by the first piece of data that they see. If I were to translate this to common retail behavior, you walk into a store and you look at a pair of shoes, okay, and this pair of shoes is like 20,000, and then you move on and you find another pair of shoes which is 10,000. Okay, say, hey, this pair of shoes is far cheaper. I'll take it. You do not think whether 10 is absolutely expensive or cheap. You're only comparing it and relating it to something else you saw, which was 20,000. And in relation to the 20,000 or the first set of data you saw, you think this shoe is much cheaper. And you go ahead and buy it without thinking whether 10,000 by itself is good value or not. And just translate this to stocks. Okay. Just because a stock was priced 100 earlier and now it is 50, you go ahead and buy it without figuring out whether 50 is good value or not.
Yeah. Absolutely. And, I think that the consequences of all this would be rather detrimental. So can you just tell us what the consequences could be of some of these? You spoke about just being in a portfolio with only losers, or how we want flowers to bloom and we end up, with only the weeds or the seeds. So what could be the consequences of some of these big mistakes that investors are so accustomed to?
Yeah. So take, for example, if you were extrapolating an observation, and what might this observation be? You did well in one F&O trade. You did well in one derivative trade. And you think that, hey, I'm an expert. I know how to do this. And you keep putting on more and more money into derivative trading. And we all know the SEBI report is all out there, right? They said 9 out of 10 traders lose money. But when you're doing that derivative trade, you don't think this. You think that you're an expert. and you go extrapolating this and end up taking more and more risk into your portfolio. Whether it is derivative trading, which is an extreme way of putting things, the other way is you're adding on, say, micro caps, you're adding on SME stocks, maybe. Okay, just because you found one IPO doing well, you start investing in every IPO, and with every IPO that you invest, you're putting in more and more money, and the size of your bets keeps increasing till one day it becomes uncontrollable, and one mistake or one act which is not in your control, the market falls for any reason, or it was a bad IPO, bad quality, you end up losing a lot of money. So these biases can make you end up taking risks which are not in your control. Okay, so the best thing is the markets are not in your control, but I myself, can exercise control on my decisions. Every investor can exercise control on their own decisions. Okay? And that is by recognizing these biases and controlling, for example, representativeness, anchoring. So if you have an anchoring bias, go ahead and do research better. Don't depend on what you observed in the first case. Figure out more data points, do some more digging, and then take a better decision. So then your discrimination power is better. Okay. And the other thing is you may end up having wrong benchmarks. Okay, if you have this anchoring bias. So wrong benchmarks, wrong references. Okay. So you may make a buy or a sell with a trigger that is not relevant at all to the case. Okay. You just because you've doubled stock, which can easily happen in a bull run, right? We've been seeing that happening. You may sell it. So doubling is a trigger. Okay. But actually, that particular business may still have a long runway. It may have way to go. And after some time, you realize, heck, actually, that was a 10 bagger and you sold it after 2x. Just because you have this anchor in your mind that, oh, I've doubled it, 200 with reference to 100. And you take a decision without examining the facts of the case.
Okay, yes, indeed. And I also find, that sometimes people try to invest without actually having a goal in mind, and they only stick to maybe one select type of stocks or, one select sector. Do you think that is also something that investors need to do to make sure that's a classic mistake or a trap that they're falling into, that they don't actually have a goal and that they're not really diversifying their portfolios?
So it's a classic evil. Okay, one of the investing evils that one should try to get away with. If you invest without a goal in mind, it's like the classic saying: "A ship without sail doesn't hit any shore." Okay, it goes wherever the currents take it. You have zero control on the ship. Okay, look at this way: when you get out of the house every morning, do you know where you're headed or not? You do. You know where you want to go and at what time you want to reach. But this simple philosophy or this simple discipline, if we were to apply to our investing decisions, you'd be in a far better place. You'd be reaching where you want to reach. Okay, so asset allocation as a discipline, having the right type of funds in your portfolio, all this is a result of having proper discipline, both as a habit and as an investment principle also. Okay. So again, if you have, say, like you said, a lot of sector funds in your portfolio, then you are not diversified. Okay. So concentration or wrong diversification is a classic portfolio evil.
Yeah, I'm
And
sure
you
it
may end
is.
up
And that's
losing.
what. Yeah, absolutely. But the question is, yes, investors are making all of these mistakes, but is there ways to rectify them? What can you do to rectify some of these very classic mistakes to try and actually compound your wealth?
Okay. I think what needs to happen is a better level of awareness in general. Okay. So awareness about managing your personal money and awareness about markets, the way they behave. It's like learning math or physics or biology in school. I think one needs to learn this. Since they don't teach this in school, all of us have to learn this outside school, outside college. We need to spend some time either learning it or asking a financial planner or a registered investment advisor to give this gyan, okay, which is great. Otherwise, one should look in and see that basically there has to be balance. Okay, if you've got your portfolio open in front of you, do you have sufficient diversification? Do you have over diversification? It's something that you can do yourself. If you have too many funds in your portfolio, you're not getting. Remember, if you're over diversified, you end up performing less than average. You won't even be hitting the benchmark. You'll be below benchmark if you're over diversified. Because remember, not all investments match the benchmark. There are a whole lot of them which underperform and a few of them which outperform. So if you have too many funds, then you're bound to underperform the benchmark also. Okay. So please look, don't be over diversified. Okay. The opposite, don't be concentrated either. If you want to take a risk in a sector fund or a thematic fund, ensure that it is only a small, tiny part of your portfolio. Okay. Don't let it go beyond 5 or 10% of your portfolio. Because we all know that even thematic funds and sector funds go through the cycles. And when the fall happens, the fall can be bad. It can hurt you. So making it a small part of your portfolio will not hurt your portfolio if it goes bad. On the flip side also, remember to look holistic at your portfolio. Don't invest some sum in equity and say, oh, I put so much money into equity. What percentage is that of your total wealth? Is it going to impact? Is it going to make it beat inflation or not? If it's only a small, tiny part of your whole wealth, it's not going to have an impact. You may think that, yes, I've invested, but what is the point of investing if it is not going to have an impact? Okay. So you may just find that most of your wealth is illiquid assets. So liquidity, diversification, asset allocation. If you can't go to a registered investment advisor, look at it yourself and try to figure it out.
Absolutely. Hope you took note of that. And yes, guys, we want to try and answer all your questions and queries live with our guest. So we've got some questions in the comment section. If you've got any queries, please do type them out. Well, we've got a question then, I think from Ro or someone by the account of Everything Everywhere saying, I'm a senior citizen and I want to invest 15 lakh rupees. Where do you think I should invest? I think, there would be a lot of people who are in the same boat, that what would be the most prudent investment strategy, being a senior citizen, having that low risk appetite and having a sum of about 15 lakh rupees. Your advice?
Yeah. All right. Classic mistake. Okay. What is the mistake here? You are saying a sum of 15 lakhs rupees and you have not mentioned to me what is it as a percentage of your total wealth. Okay, without knowing what is the percentage of the total wealth, it cannot be advised upon. If 15 lakhs is 1% of your total wealth, well, if you have time and you have the ability to go through sharp drawdowns in the equity markets, you can examine equity. But if you have too much of equity already, then you need stability for your portfolio. Okay, so without knowing the total picture, one cannot take decisions in an absolute sense. Okay. So to give you options, if you've already decided that you have enough stability in your portfolio, okay, and this is where you want to take a risk, then you can look at passive equity funds, index funds if you're a beginner, and spread it out over the next 6 to 12 months and make your investment. If you think you already have a lot of risk in your portfolio, either because of illiquidity, a lot of real estate, which is illiquid, or you already own a lot of stocks or equity funds, then I think you should look at debt funds or bank deposits or bonds, which give stability. Okay. Or if you don't have gold, now you're understanding where I'm getting at.
Yeah.
You need different asset classes. Okay. And then only you can make a decision.
Okay, different asset classes are critical, and that's a common mistake as well that you made in asking that question first up. Okay, we have another question from Preetham Das. Do mutual fund companies matter when selecting a fund?
Oh, yes, they do. Very much. If you ever get to look at a table of all the mutual funds that are available in each category, say large cap equity. So you must understand every mutual fund has a number of schemes. Every asset management company has a number of schemes. They have tried to cover all categories of equity. They try to cover all categories of debt and also gold and silver if possible. So within each category, you will find that some are good, some are bad. Okay, and it may not always be the case that a fund is in the top position. So if you're looking at consistency, how frequently is this particular scheme in the above average category. Okay, and if it's consistently there, then you can choose that asset management company. Not all MMCs are great managers. Okay, if you do not know how to choose, then best is to go and buy a passive index fund where it doesn't matter what was the AMC. They're just buying the Nifty or the Sensex or the Nifty 100 or 200 or whatever be the case.
All right, let's take our next viewer question then. And we've got a query from Ro who asks, please suggest the best liquid funds to park money for the next 2 to 3 months. Do you think that arbitrage funds are better than liquid funds for the same time frame? But it's a very short time frame, 3 months.
All right. Okay. If it's a 3-month short time frame, then arbitrage funds may not give you the expectation. If you have at least a 90 to 180 day kind of a situation, then arbitrage funds are more consistent in their performance. And because of the tax benefit that they have, the post-tax return of an arbitrage fund is better than a liquid fund. But let me tell you, nothing is as safe as a liquid fund. Okay, it has so less volatility, you will just not feel it. Okay, it's one of the most stable instruments that one can look at. It will always give you the short-term rate of return, but the safest rate of return, even safer than arbitrage funds. Okay, so if you have at least the more than 90 days or 180 days plus, then an arbitrage fund is a good option because the 180-day volatility is very less. You'll not feel it. Okay, and otherwise a liquid fund. Okay. Any of the large asset management companies, you can go. It's almost like a commodity, the liquid fund. You can go for any of them. Just ensure that the liquid fund has mostly AAA securities, P1 plus securities, and Government of India securities. Okay, the good ones will have 85-90% in these categories. That you're cool.
I hope we got that question answered for you. And we have another query then from Preetham Das, and he asks, it's sort of like a follow through to what he asked before. It's, what should one consider when deciding whether or not to buy a fund?
Whether to buy a fund, is it right?
I guess choosing a mutual fund, what should you consider?
Okay, all right. So here we should look at the track record. So it's not that something new is not good, but you want to be sure something is good. Look into the history and try to figure out whether it's made mistakes at any point of time. Try to look and see if it has been consistent. So you should drill down. You have the asset management company, which is of a good pedigree. Okay, you need to have it as a good pedigree. And then within the schemes of the asset management company, you have to drill down and check for the category that you're looking, do you have consistency in gains? It need not be the number one performer, my friend. Okay, but if it is always in the above average category, you're okay. You can go in for those. Don't get tempted by flash in the pan performances. Just because it's number one in the league table, it may not be number one next year. Somebody else will do better, but ensure that they're always in the above average category. We call it the top 2 quartiles of performance. Ensure they're all. So on the one, if you're looking at a 10-year time frame, okay, how many calendar years have they been in the above average category? Choose the ones that are higher, the maximum number of times in the above average category, and go for it.
Okay, there you go. I hope we were able to answer your questions. And thank you so much, Srikanth, for joining in and giving us a view on the classic mistakes and how good can triumph evil when it comes to those terrible investing habits. With that, ladies and gentlemen, we'll wrap it up on the Daily Finance Wrap. Thanks so much for tuning in. Remember, this is your daily dose of all personal finance related information, questions and queries, be it in real estate, be it insurance, loans, and lots more. And we go live every day at 6 p.m. So hope to see you on every weekday. Thank you so much, all of you, for watching. It's a wrap.
Thank you.